Welcome back to Bloomberg. Well, our next guest has a $14 billion Rowe Price equity income fund under his own direct management, and it has been outperforming 99% of its peers the past month. What's his winning strategy? Brian Rogers, Chairman, Chief Investment Officer, and Portfolio Manager of Rowe Price, joins us now from Baltimore, Maryland. Good morning to you, Brian. Thank you so much for coming on. I'm very excited to have you on the program. That's an impressive track record to run through these days. 99% of your peers. How are you doing that?
Well, Margaret, what we've been betting on is the fact that at some point the economy will begin to pick up and the news will be not quite as bad, and so companies with any type of financial or cyclical exposure should benefit. So we're contrarians with respect to the equity income fund, and some of these companies are slowly beginning to come back into favor.
And looking at the breakdown of your sector allocation, you've got about 20%, 19.8 to be exact, into financials right now. Do you believe financials are going to provide leadership? Because in many ways, they're sort of trying to figure out the new identity. Just this week, we saw Morgan Stanley really sort of come forward more as a retail bank, less of an investment bank in terms of the street's perception of its core business. If financial sector is remaking itself, you still believe in it strongly? Yeah,
no, I think so. There are many different types of companies, obviously, and the companies have gone through a ringer over the last 18 months, and usually that creates a good opportunity prospectively. So whether it's, J.P. Morgan or U.S. Bancorp or Goldman Sachs, these are companies that were under so much pressure over the last 18 months that they reach price points which look really attractive to us. And these are well-run companies, and they know how to respond to adversity, and so we feel comfortable that they'll be good investments over the next couple of years.
Now, why, if they're among your top holdings, a lot of talk about what's happening in Washington on the health care front and the potential costs that may happen for pharmaceutical companies, for health insurance companies. Why do you still feel strongly about Wyeth?
Well, of course, Wyeth is being acquired, so that
right.
will disappear at some point. I think healthcare is not a huge sector for us. We have a couple of investments in things like Wyeth and Merck and WellPoint. And again, good companies. I mean, Merck is a very, very cheap stock, admittedly with a bunch of issues. And, we're fairly comfortable. I think I'll really worry about healthcare reform when it's actually done, because there are so many cross currents, it's tough to tell what the outcome really is going to be.
Now, you have about 90% of your assets back home in the U.S. in domestic stock. There had been a lot of buzz about decoupling and that theory that, Asian growth is rebounding right now. China's been the first to come out of recession. We just learned within the past few weeks there'd been a lot of hope there that the emerging market growth that we may begin to see would help lead the U.S. out of recession. You are already betting here at home substantially. Why?
Well, Margaret, we're primarily, again, the fund I manage is primarily a U.S.-based fund. At Rowe Price, we have a lot of really good emerging market and international funds, but most of what we do with equity income is U.S.-based. So as you point out, only 10% of our assets are held overseas.
But a substantial portion of, when you look at the energy businesses that you have in the portfolio, you own a Royal Dutch Shell, you own ExxonMobil. Big part of those U.S. companies is what's happening in terms of emerging market demand. So how closely do you watch what's happening in Asia right now?
Well, I watch fairly closely. I was just on a call with some of our folks in Singapore just a few minutes ago, and business is picking up there. Your comments about Royal Dutch, I think many of the companies we invest in, I almost consider to be global companies. And whether it's Royal Dutch or Coca-Cola, I mean, these may or may not be U.S. or non-U.S. companies, but they really have global operations, and I think you have to look at them as such.
Right. You almost can't look at domestic stocks as being decoupled, right? I mean, do you believe in that theory at all?
Well, I'm always a skeptic of decoupling. I think things can decouple a lot in the very short run. But I suppose I'm a disciple of Tom Friedman, the writer, when he talks about the world being flat and how interconnected everything is. And so I don't believe in decoupling over the long term, because I do think in today's world we are all connected.
So what are you hearing when you speak to some of your clients right now? What's the sentiment for retail investors and some of your colleagues as well?
Yeah. Well, I think obviously investors and my colleagues, and myself for that matter, Margaret, feel better after the market rebound we've seen over the last few months. I think many retail investors are a little bit more willing to take on more risk right now. In part, they're almost running away from low yields on safe investments like money market funds and treasury bills. And I think after events of the last 12 months, people were really frightened last fall because the world was, quite frankly, on the brink. Mm-hmm. I think as we sit here in the middle of 2009, the individual investor feels a little bit more positive about the macro environment. And while turnarounds take a fair amount of time, I think the individual is willing to take a little bit more risk with his or her money.
All right. Thank you so much, Brian Rogers, Chairman, Chief Investment Officer, Portfolio Manager at T. Rowe Price.